I've been trading silver for over a decade, and I'm using this AI format because it is the fastest way to get time-sensitive data to you without the production delays that plague traditional content. And right now, speed matters more than ever. Because while most of the world was asleep a few hours ago, silver didn't just move. It ripped to a new all-time high of $88.37. I was looking at the screens early this morning, January 14th, 2026, and what I saw was a reality that has never existed in human history. The mainstream media is already spinning this. They're calling it speculative mania. They want you to believe this is a bubble driven by Reddit boards and meme stock energy. CNBC will be running segments later today about retail frenzy and how the little guy is piling into precious metals with no understanding of fundamentals. But here's what they're missing. The screen is lying to you. The price isn't rising because people are buying. The price is exploding because the physical metal has vanished. And I don't mean supply is tight or premiums are elevated. I mean the actual deliverable metal that's supposed to back these paper contracts is gone. And while the talking heads are staring at the price chart like it's a lottery ticket, they are completely missing the Department of Justice subpoena that just landed on Jerome Powell's desk, which changes absolutely everything about how we need to think about not just silver, but the entire precious metals complex. So let me be very clear about what I'm seeing right now. We are witnessing what I can only describe as a perfect storm. The weaponization of silver supply by China, combined with a criminal investigation into the Federal Reserve, has broken the silver market's pricing mechanism forever. Not temporarily, forever. In this video, I'm going to pull back the curtain on something called backwardation. It's the hidden trap that is currently destroying the short positions in real time. I'll run the actual math on the 230 million ounce deficit. I'll show you the kill switch the CME just pulled to try to stop the bleeding. And I'll share my personal battle plan for navigating a world where silver is heading to $100 and gold is on a path to $5,000. But before we look at the charts, you need to see the on-the-ground numbers that the banks are desperately trying to hide. As of a few hours ago, silver spot is sitting at $88.21. Gold is at $4,630, knocking on the door of the $5,000 Fibonacci extension that I've been tracking for months. But here's the number that should concern you most. Look at the DXY, the dollar index. It's at 98.82. That's the steepest 3-week drop in years. The world is selling America in real time. Foreign central banks are rotating out of treasuries. Sovereign wealth funds are moving into hard assets. This isn't speculation. This is showing up in the custody data. Now, let me show you the inventory crisis that's driving this move. Silver lease rates have spiked above 8%. Let me put that in plain English for you. It has never been more expensive to borrow physical metal because there is no metal to borrow. Lease rates are the cost of borrowing silver for short-term delivery. When they spike like this, it means the bullion banks and refiners are screaming for physical supply that doesn't exist. Think about what that means. The paper price is $88. But the physical reality is that if you want actual metal delivered to your vault today, you're paying a premium that makes the spot price look like a joke. And here's where it gets really interesting. On January 7th, the CME raised margin requirements to $32,500 per contract. That's a 47% increase in one move. This was a desperate attempt to kick small players out of the game before the delivery failure hits. Because when you raise margin requirements that aggressively, you're not trying to manage risk. You're trying to collapse open interest before someone shows up asking for their metal, and you have to admit you do not have it. But why is the metal gone? To find the answer, we have to look east, to a band that changed the world on New Year's Day. Let me teach you something that most analysts don't understand. Backwardation. Simple definition. It's a market state where the price for immediate delivery is higher than the price for future delivery. Think of it like this. It's like a ticket to a sold-out concert. If you want a ticket for tonight, you'll pay 3 times the price of a ticket for a show 3 months from now. Because tonight is the only time that matters. The future date has no value if the event you care about is happening right now. That's what's happening in silver today. Silver is in what I call super backwardation. I was looking at the contract roll data this morning, and 3,000 COMEX contracts just rolled backward from March delivery to January and February. 3,000 contracts. That's 15 million ounces of silver, where the buyers are not waiting for March. They are demanding their silver now. Why does this matter? Because this proves the paper price and the physical reality have completely decoupled. The shorts, the people who sold silver they didn't have, expecting the price to fall, are now being forced to buy physical metal at any price to close their positions. And every time they buy, the price goes higher, which forces the next short to cover at an even higher price. It's a feedback loop, and it's accelerating. Stop. Look at this chart. If you think $88 is high, you haven't seen the math of what I call the great deficit. Let me walk you through the conservative scenario first. 2025 saw a 230 million ounce deficit. Total supply was 1.01 billion ounces. Total demand was 1.24 billion ounces. That's the fifth consecutive year of a deficit. 5 years in a row where the world consumed more silver than it produced. Even if demand stays flat, which it won't, the math says the vaults go to zero. It's not a question of if, it's a question of when. Now, let me stress test that number with what I call the China factor. China's January 1st export ban effectively weaponized 60 to 70% of global refined silver. They're not selling to the West anymore. They're hoarding for domestic consumption, particularly for their solar and EV industries. If you subtract China's supply from the global market, the 230 million ounce gap doubles. We're not talking about a tight market. We're talking about a structural supply failure that cannot be solved at any price in the short term. And here's the disconnect that should terrify you. We are pricing a multi-year shortage with a paper currency, the dollar, that is currently under Department of Justice investigation. The integrity of the Fed's balance sheet is in question. The integrity of the Treasury market is in question. And we're using that same currency to price the hardest asset on Earth. Stop. Look at this chart. The gold to silver ratio is crashing toward 45 to 1. For context, the long-term average is around 60 to 1. We were at 80 to 1 just 18 months ago. This ratio is compressing faster than I've ever seen in my career. Most people see this and scream by. But the skeptics have one very powerful argument that could tank the price tomorrow. And I need to address it head on. Let me recap where we are. We know the physical metal is gone. We know the Fed is in legal chaos. We know China has closed the gates. So the skeptics look at this and say, high prices cure high prices. Their argument goes like this. $88 silver will trigger massive thrifting in the solar industry. Companies will switch to copper or aluminum. Grandma will sell her silver spoons. Scrap flows will flood the market and the price will collapse under its own weight. It's a compelling argument, and it's wrong. Here's why. Industrial switching takes years, not weeks. Solar panel manufacturers can't just redesign their entire production line because silver went up $20. They have long-term contracts. They have engineering constraints. They have capital expenditure cycles that take 18 to 24 months to execute. As for scrap, most of the easy scrap was already sold at $30 and $50. The people who were willing to part with their silver for quick cash already did. The people still holding at $88 aren't looking to sell. They're looking for protection from a collapsing dollar. And let's destroy one more myth while we're here. This isn't the Hunt brothers. This isn't two billionaires trying to corner the market in 1980. This is 2 billion people in 5 central banks realizing that their paper currency is burning and they need something real. So if the skeptics are wrong, what is the kill switch the institutions will use next? Let me show you what I'm watching. The institutional hammer is coming. Watch for position limits or trading for liquidation only rules. PCO. That's when an exchange says you can sell, but you can't buy. It's a circuit breaker designed to protect the clearinghouses when the market breaks. The CME already hiked margins by 47%. They can do it again. They can do it tomorrow. Here's my dashboard. The 3 indicators I'm watching every single day. Number 1, silver lease rates. If these cross 10%, the market is officially broken. We're at 8% now. We're 2 percentage points away from a declared emergency. Number 2, the Powell investigation. If an indictment is handed down, the DXY could find a floor at 0. I'm not exaggerating. The dollar index is built on confidence in the Federal Reserve. If that confidence evaporates, foreign holders will dump treasuries and the feedback loop will be catastrophic. Number 3, the gold to silver ratio. I'm watching for the break of 45 to 1. If we see gold at 5,000 and silver at 100, we'll be sitting right at 50 to 1. That's the signal that the ratio compression is accelerating, not stalling. Now, there's one more thing I need to address. It's unverified, so take it with appropriate skepticism. But there's a rumor circulating in the institutional space that a major bullion bank is facing a $10 billion insolvency tied to silver derivatives. If that's true, $100 silver is just the starting line. Because when one bank goes down, the contagion spreads fast. I'm not here to tell you what to do. I'm here to tell you how I am navigating this minefield. This is not financial advice. This is my private journal. These are the conditional triggers I'm using to make my own decisions. First, the weight trigger. If silver touches $95 this week on a vertical parabolic move, I'm personally pausing all new physical purchases. I'm not chasing a vertical line. I've been through enough blow-off tops to know that when the chart goes parabolic, you step back. I will wait for a retest of the $80 breakout zone. That's my re-entry point for physical. Second, the aggressive trigger. If the DOJ formalizes an indictment against Jerome Powell, I am looking to increase my exposure to gold miners, specifically GDXJ, the junior gold miners. I believe they haven't priced in the $5,000 gold scenario yet. The leverage on those names in a $5,000 gold environment, is something most people aren't calculating correctly. Third, the patience trigger. If the CME raises margins another 20% or more, I will sit on my hands. I will do nothing. Because when they raise margins that aggressively, they're trying to flush out the weak hands. And when the weak hands are forced to sell, that's when I look to enter new positions. Not before. We are entering the endgame phase of the metals cycle. The moves are getting violent, the stakes are getting higher, and the institutions are deploying tools they haven't had to use in decades. Let me bring this together. Silver is at $88 because the physical supply is broken, China has locked the doors, and the Fed is under criminal investigation. Those three forces are not going away. They're compounding. We aren't watching a price increase. We are watching a currency collapse. History doesn't repeat, but it's definitely rhyming right now. The parallels to 1971, when Nixon closed the gold window, are impossible to ignore. We're watching the unraveling of a monetary system in real time. This is the most dangerous and most profitable time to be in these markets. You need to be awake, you need to be informed, and you need to be ahead of the curve. To understand how the $5,000 gold scenario ties into the DXY's death spiral, you need to see the data I gathered in my last update. Watch it now before the next London Open, because by the time the European markets wake up, the landscape could look completely different. I'll see you in the next one.